Okay, let's dive right in. We are looking at a true modern mystery in the financial and tech worlds today. Here's the billion-dollar question. Why would a wildly successful video game giant, literally a company printing money year after year, suddenly decide to completely erase itself from public trading?
Welcome to This Explainer. Today, we're breaking down Electronic Arts' historic, monumental shift from a public titan of the NASDAQ to a highly secretive private empire. We're going to unpack the numbers, the strategy, and the massive shockwaves of a $56.6 billion plot twist.
Part 1. The Ultimate Game Strategy. To really grasp this pivot, you first have to understand just how hard EA was dominating the public market right up until the end. I mean, they weren't struggling. They were absolutely thriving. Look at October 2025. Their marquee title, EA Sports FC 26, sold a staggering 12 million copies in barely over a month. It completely crushed the charts, ranking as the #1 best-selling game of the year in 16 of the 17 European countries surveyed. That is wild.
And breaking down those sales reveals a really distinct hierarchy. PlayStation commanded the lion's share, pulling in 67.5% of early sales. The PS5 alone accounted for the vast majority of that success, while Xbox and PC trailed significantly. Basically, EA had a total stranglehold on the console market's most lucrative real estate.
But the real engine behind EA's success wasn't just box sales. It was perpetual player engagement. Out of their roughly $7.5 billion in total net revenue for fiscal year 2025, a jaw-dropping $4.4 billion came from extra content. Driven largely by live services like Ultimate Team, they had essentially built a perpetual money-making machine.
Part 2. The $2.5 billion setup.
Flush with all this cash, you'd think EA was just sitting back, enjoying the ride, right? Well, instead, they were aggressively rewarding their public investors. In its last 12 months as a public entity, EA spent a massive $2.5 billion repurchasing 17.8 million of its own shares. That includes $375 million in the first quarter of fiscal 2026 alone. To the average investor, this signaled incredible confidence. It looked like absolute financial strength.
Part 3. The $56.6 billion plot twist.
So, just as the world saw EA as this unstoppable public machine, a historic transaction fundamentally flipped the script. In the absolute largest leveraged buyout in the history of the video game industry, EA was taken private for $56.6 billion. The buyers? A high-powered consortium led by Saudi Arabia's public investment fund, rolling over their existing stake, alongside private equity heavyweight Silver Lake Partners.
And this takeover moved with blistering, almost unbelievable speed. Rumors spiked in September 2025, and by the end of that month, the board accepted a $210 per share bid. That's a very healthy 25% premium, by the way. Shareholders overwhelmingly approved it in December, and by April 2026, EA officially delisted from the NASDAQ poof. 37 years of public history gone in a matter of months.
The financial engineering required here is just staggering. To pull off a leveraged buyout, or LBO, of this scale, JP Chase orchestrated a monumental $20 billion debt package. This single move proved that the appetite for mega buyouts was roaring back among major banks, even in a complex economic climate.
The newly private company wasted zero time restructuring for this new reality. By June 2026, leadership was completely realigned. David Tinson stepped up as Chief Experiences Officer, focusing on global communities. Cam Weber took charge of creative portfolios as Chief Studios Officer, and Laura Mealy pivoted to drive enterprise growth well beyond their core business. They unified their creative, tech, and business wings under one private roof, entirely free from the public eye.
Part 4. Escaping the quarterly treadmill.
So why? Why would a cash-generating giant walk away from the prestige of the public exchange? Well, it all comes down to escaping what insiders call the quarterly treadmill. In the public market, you're ruthlessly punished if you miss short-term earnings targets, but modern game development requires decade-long cycles. Private equity freedom allows EA to focus on 10-year horizons without Wall Street analysts breathing down their necks every 90 days. On the ground, this freedom translates to massive, unproven risks taken in total secrecy. EA can now let premium studios like BioWare and DICE take the time they actually need. Even more radically, they plan to integrate generative AI to potentially slash open-world development costs by 40% over 3 years. Plus, they're eyeing a proprietary gaming mega app to bypass traditional app stores entirely. These are massive swings that would be far too risky to attempt under the public spotlight. This dynamic fundamentally fractures the tech landscape into two distinct models.
On one side, you have the massive public mega platforms like Apple and Microsoft fighting for public dominance. On the other, you have these newly minted, highly secretive private equity-powered giants, like the new EA. They rely on agility and vast pools of private capital to disrupt the industry from the shadows.
Part 5. The Ripple Effect. A record-breaking $56 billion acquisition doesn't happen in a vacuum, right? The fallout is massive. Institutional shareholders and banks like JP Morgan won big, while Saudi Arabia's PIF rapidly advanced its global gaming goals. But for competitors, companies like Take-Two and Ubisoft are now scrambling to justify their own valuations. Meanwhile, giants like Sony and Microsoft face an aggressive, unconstrained EA that no longer has to play nice for public shareholders.
And there is a real cost to the public here. Perhaps most importantly, this delisting leaves everyday retail investors with fewer and fewer options to capture gaming profits. It effectively gatekeeps one of the entertainment industry's most profitable growth engines behind the high walls of private equity. It's a real hollowing out of the public gaming sector.
Also, consider the regulatory angle. For years, agencies like the FTC blocked standard mergers. Just look at the intense scrutiny over Microsoft and Activision. But this LBO proves a fascinating loophole. Massive, horizontal industry consolidation might be easiest when led by private financial entities, smoothly slipping past the traditional antitrust hurdles that stall direct competitors.
The rules of corporate gaming have been permanently altered by EA's $56.6 billion exit. The blueprint is there, the capital is hungry, and the quarterly treadmill is only getting faster. So we have to leave you with this final provocative thought. If the biggest publisher in the world can disappear into the shadows of private equity, who is next?